For nearly a century, American International Group was the gold standard of boring, unshakable corporate stability. If you bought life insurance, secured a commercial shipping fleet, or protected a multinational business, you trusted AIG because they were the absolute fortress of the financial world. They held a pristine AAA credit rating, a rare seal of approval reserved for institutions considered as safe as the United States government itself. They sat on more than $1 trillion in assets. To families, CEOs, and global regulators, AIG wasn't just a company. It was the safety net beneath global commerce. Then, over the course of just 72 hours in September 2008, the fortress collapsed into a black hole that threatened to swallow the entire global economy overnight. When the dust settled, the U.S. government had to hand over $85 billion in emergency cash just to keep AIG's doors open until morning. Within months, that bailout would balloon to more than $180 billion of taxpayer money. The chairman of the Federal Reserve, Ben Bernanke, would later admit to Congress that out of all the chaotic disasters during the 2008 financial crash, AIG was the single institution that made him the angriest. The natural question is, how? How does a traditional insurance company, whose entire existence relies on conservative math and careful risk management, suddenly become the deadliest financial bomb on Earth? The answer wasn't hidden in auto insurance policies or hurricane claims. It wasn't even happening at corporate headquarters in New York. The catastrophic failure of trust was quietly unfolding across the Atlantic, inside a sleek, unassuming office building in the wealthy London neighborhood of Mayfair. There, a tiny subsidiary called AIG Financial Products operated almost entirely in the shadows. They had just 400 employees out of AIG's global workforce of 116,000. Yet, this obscure division had discovered what felt like financial alchemy. They had found a way to generate billions of dollars in pure, unadulterated profit without underwriting a single traditional insurance policy. Instead of selling protection to everyday families, they were selling private guarantees to the most powerful investment banks on Wall Street. Imagine a high-stakes casino where gamblers make billion-dollar bets on whether a neighborhood will burn to the ground. AIG Financial Products stepped into that casino and offered to insure every single bet, promising to pay out fully if the fires ever started. But because of a massive loophole in financial rules, they never set aside a single dollar in cash to cover those promises. They just collected the upfront fees and handed out millions in executive bonuses. Wall Street banks bought these guarantees by the truckload because AIG's golden reputation made the contracts look bulletproof. Regulators assumed the insurance titan knew what it was doing. Corporate leadership assumed the London office was just printing free money. Everyone played musical chairs, assuming the music would never stop. But someone inside the company had already seen the real numbers, and she realized the fires were about to start. To understand how a tiny division in London managed to rig a financial time bomb under the global economy, you have to look at the man running the show, Joseph Cassano, and the financial product he turned into a goldmine. The product was called a credit default swap. The name sounds like dense Wall Street jargon, but the concept is terrifyingly simple. It is essentially an insurance policy on a loan. If a major investment bank loaned billions of dollars to corporations or homeowners, they worried about what would happen if those borrowers defaulted. So, the bank would knock on AIG Financial Products' door and ask for a guarantee. AIG would agree to pay back the loan if the borrowers went bust. In exchange, the bank paid AIG a steady stream of quarterly fees, just like you pay your car insurance premium every month. On paper, this looked like the greatest business model in human history. During the early 2000s, the global housing market was booming. Everyone believed real estate prices only ever went up. Because AIG possessed that rock-solid AAA credit rating, the financial rules of the era granted them an extraordinary privilege. When normal companies write insurance, Regulators forced them to keep billions of dollars in actual cash sitting in a bank vault just in case disaster strikes. But AIG was viewed as untouchable. Regulators let them write these guarantees without putting aside a single dime in reserve. Think of it like co-signing a loan for a neighbor. If you have perfect credit, the bank doesn't ask you to leave a suitcase of cash as collateral. They just take your signature. Now imagine you discovered you could charge people $10,000 a pop just to co-sign their mortgages. If you assumed nobody would ever miss a payment, you would sign as many documents as your hand could manage. You would feel like a genius, collecting millions of dollars in free cash without ever spending a cent. That is precisely what AIG financial products did. They didn't just co-sign a few loans. They co-signed nearly $500 billion worth of debt, and a massive chunk of it was tied directly to American subprime mortgages, home loans given to borrowers with terrible credit histories, zero down payments, and no verifiable income. Inside the London office, the bonuses flowed like water. Cassano and his small team were generating hundreds of millions of dollars in pure profit, which inflated AIG's stock price and made the parent company look unstoppable. But behind locked doors, the mathematical models justifying this entire house of cards rested on a single, fatal assumption: that national home prices could never fall all at once. When internal auditors and risk managers finally tried to peek inside the London division's books to see what would happen if housing prices actually dropped, they were met with extreme resistance. Wall Street banks knew the foundation was cracking, and they began preparing a trap. It should have been impossible to hide. It wasn't. In August of 2007, as whispers of trouble in the housing market began circulating through the news, Joseph Cassano got on a conference call with anxious investors. He delivered a sentence that would go down as one of the most infamously arrogant predictions in modern corporate history. He stated, on the record, that it was hard for them, without being flippant, to even see a scenario within any kind of realm of reason that would see them losing $1 in any of those transactions. People trusted him. Why wouldn't they? His division had generated more than $3 billion in profit over the previous decade, but inside the building, the alarms were already screaming. Genevieve Jacobs, a senior risk auditor at AIG, had begun trying to look under the hood of these massive mortgage deals. What she discovered was chilling. Nobody inside the London division could actually prove what kind of mortgages were bundled into those financial packages. When she repeatedly pushed for transparency and warned leadership that they were sitting on unmeasured, catastrophic risk, she wasn't rewarded. She was sidelined, stripped of her oversight responsibilities, and eventually pushed out of the company altogether. The corporate machine didn't want the truth. The truth would shut down the bonus pipeline. Imagine driving down a winding mountain highway at 90 miles per hour. Your passenger leans over, points at the dashboard warning lights, and tells you the brake lines are severed. Instead of taking your foot off the accelerator, you simply turn up the radio and tell the passenger to get out at the next stop. That was AIG's risk management strategy. While AIG executives were turning up the music, their biggest Wall Street clients were quietly preparing a slaughter. Investment giant Goldman Sachs had bought billions of dollars worth of these credit guarantees from AIG. But unlike AIG's leadership, Goldman's traders were actively digging into the real street-level data. They saw everyday homebuyers defaulting on their mortgages just weeks after signing the paperwork. They realized the American housing market was rapidly rotting from the inside out. And Goldman Sachs knew something lethal about the insurance contracts they had signed with AIG. Buried inside the fine print was a hidden trapdoor, a legal clause that Cassano and his team had agreed to during the good times because they assumed it would never be triggered. That clause stated that if the value of those subprime mortgages began to drop, or if AIG ever lost its pristine AAA credit rating, the Wall Street banks didn't have to wait for actual loan defaults to get paid. They could legally demand that AIG immediately deposit billions of dollars in hard cash as collateral to cover potential future losses. It was like a landlord suddenly knocking on your door and legally demanding you pay 10 years of rent by tomorrow morning just because your credit score dropped a single point. AIG didn't have the cash, and Wall Street knew it. The first domino fell in late 2007. Goldman Sachs picked up the phone and made a formal demand to AIG. The mortgage assets backing our contracts are sinking in value, so send us $1.5 billion in cash collateral right now. Inside AIG, shock turned to outright denial. Executives argued furiously, claiming Goldman's valuations were overly pessimistic, completely artificial, and simply wrong. But Goldman wasn't negotiating. They had the contract and they had the legal right to demand the cash. By early 2008, as American housing prices accelerated their downward spiral, Goldman demanded even more. Soon, every other major financial institution on Earth smelled blood in the water. Banks like Deutsche Bank, Societe Generale, and Merrill Lynch lined up at AIG's door, demanding billions in collateral of their own. AIG was suddenly experiencing the corporate equivalent of a classic bank run. Imagine a local bank with only $10,000 sitting in the vault, but 100 terrified customers outside, each holding a slip of paper demanding $1,000 in cash right this second. If the customers stay calm, maybe the bank survives. But if they stampede the doors all at once, the bank is crushed instantly. By September of 2008, the stampede became an earthquake. On September 15th, investment giant Lehman Brothers officially filed for bankruptcy. Pure panic gripped the planet. Wall Street froze up completely. No bank would lend money to another because nobody knew who was truly solvent and who was about to die next. Then came the fatal blow. On September 16th, credit rating agencies looked at AIG's bleeding balance sheet and stripped the company of its pristine credit rating, downgrading it multiple notches in one fell swoop. That downgrade pulled the pin on the financial grenade. Remember that hidden trapdoor buried in the contracts. The downgrade instantly triggered massive, non-negotiable cash demands across AIG's entire global portfolio simultaneously. Over the course of just a few hours, AIG was hit with requests for more than $14 billion in immediate cash. They didn't have it. Their liquid reserves were completely gone. At corporate headquarters in New York, executives scrambled frantically to secure private emergency loans. They begged Warren Buffett. They pleaded with private equity titans. Nobody would touch them. AIG was weeks away from celebrating its 90th birthday, yet it was now less than 24 hours away from total, catastrophic bankruptcy. And this is where the terrifying reality of AIG's tangled web finally dawned on government regulators in Washington. AIG wasn't just another dying corporation. It was the load-bearing pillar holding up the entire tent of global capitalism. If AIG went bankrupt on Tuesday morning, every single insurance guarantee it had written to every major bank on Earth would become worthless paper instantly. Without that insurance protection, those global banks would immediately violate their own financial safety rules and collapse in a synchronized chain reaction. Within days, everyday employers wouldn't be able to borrow money to make payroll. Shipping lines would halt. ATMs would stop dispensing cash. The U.S. government had only hours left on the clock. They had to make the most agonizing choice in economic history. On the night of September 16, 2008, inside a tense conference room at the Federal Reserve Bank of New York, government officials faced a brutal reality. They could let capitalism take its course and watch AIG go bankrupt, knowing it would likely trigger a second Great Depression by morning. Or they could swallow their pride, step in with taxpayer money, and rescue a company whose greed and arrogance had brought the world to the brink of ruin. They chose the rescue. The Federal Reserve announced an unprecedented $85 billion emergency loan to AIG, taking a nearly 80% ownership stake in the company. In practical terms, The United States government had just nationalized the biggest insurance giant on the planet. But the financial bleeding was so catastrophic that $85 billion wasn't nearly enough. Over the following months, the rescue fund swelled to a staggering $182 billion. To everyday taxpayers watching the news, it felt like an incomprehensible injustice. Why should families who were actively losing their homes to foreclosure pay to keep an insurance empire afloat? But what the public didn't realize right away was that the bailout money wasn't really for AIG at all. AIG was merely a funnel. Think of the bailout like a city fire department pumping billions of gallons of water into a burning mansion. Not because they care about the arsonist living inside, but because the explosion would engulf the hospital next door. Nearly all of those taxpayer billions flowed straight through AIG's accounts and directly into the pockets of the global banks on the other side of those toxic credit guarantees. Goldman Sachs, Societe Generale, Deutsche Bank, they all received 100 cents on the dollar for their bets, fully paid for by American taxpayers. If the public was angry about the bailout, what happened next turned that anger into sheer, unbridled rage. In March of 2009, news broke that AIG was quietly paying out $165 million in executive bonuses. But these weren't just standard corporate rewards. They were specifically earmarked for the employees of AIG Financial Products, the exact same London office that had lit the match and blown up the global economy. Corporate executives shrugged and claimed their hands were tied by legal employment contracts signed before the crash. The firefighters weren't just saving the arsonist's house. They were handing him a massive cash reward for starting the fire. So, did anyone pay for this? Did the architects of this financial disaster end up in handcuffs? Joseph Cassano, the man who led AIG Financial Products and famously claimed they wouldn't lose a single dollar, stepped down in early 2008 before the final collapse. He walked away with $34 million in pay and bonuses, along with a consulting contract worth $1 million a month. Federal prosecutors and the FBI spent years investigating the London division, scouring millions of documents for evidence of criminal fraud. But in 2010, the Justice Department quietly closed the investigation without filing a single criminal charge against Cassano or anyone else in his division. Because of the massive deregulatory loopholes they operated under, what they did wasn't technically illegal. It was catastrophically reckless, morally bankrupt, and structurally lethal, but it broke no statutory laws. Eventually, AIG managed to restructure, sell off valuable global assets, and pay back the government loans with interest. The financial books were officially squared. Regulators passed sweeping reforms like the Dodd-Frank Act, forcing banks and insurance giants to hold more emergency cash in reserve and pushing complex derivatives out of the dark. Yet the real scar left by AIG wasn't on a balance sheet. It was a permanent scar on public trust. Before September 2008, most people believed the financial system was governed by strict rules, careful math, and responsible adults who knew what they were doing. The story of AIG tore the curtain away. It revealed that when ordinary people make a bad financial bet, they lose their cars, their life savings, and their homes. But when institutions grow so massive that their collapse would ruin us all, they can make the wildest, most dangerous bets imaginable, safe in the knowledge that if the math stops adding up, the rest of us will be forced to pay the tab. Nobody rang a bell to tell us the rules had changed. But once we saw how the game was truly played, we could never unsee it.